What is up, guys? Welcome back to the channel. I said that this year I'm going to be trying some new stuff with this channel. One of those things is to answer your questions. So over the last few weeks, I've been asking you to ask me anything and I'll make a dedicated video on that, answering all your questions. You guys have not disappointed. You've sent me a ton of questions. So let's not waste any time and let's get straight into it. Oh, and by the way, keep the questions coming in the comment section. If today's video makes you think of even more questions, put them in and I'll make another video next month. So first up, nice clear vid, thanks. What is the benefit of interest-only mortgage? Isn't it better to pay a little more each month and own the asset at the end? Really good question. I could tell you a yes or no, but I'm going to show you with a worked example because that's always the best way that I find to learn these things. So let's do a worked example. Say you bought £100,000 buy-to-let property on an interest-only, and this calculator is really handy, interest-only repayment over 25 years at 5%. Your monthly repayments are going to be £417 per month. So let's put £417 per month here. I'm going to explain this in more detail in a sec. And we're going to compare that to a capital and interest, so repayment mortgage. You're not just paying the interest, you're paying the capital as well. That turns out to be let's call it £585 per month. So on this spreadsheet here, you can see that interest only, your payments are going to be 417,585. Now the profit here, I'm assuming that you're going to get a rent of around £650 per month. That's about the average in the regions that I work in, that I invest in. So £417 minus 650, your profit is £233 per month. That's on an interest only basis. And over the course of the year, it's basically that times 12 months, just under £2,800 per year. That's your annual profit. Now, compare that to a repayment mortgage, that's capital and interest. Your payments are obviously going to be higher because you're paying off the interest and the capital. So your £650 rent minus your repayment of £585 per month is going to leave you with £65 in monthly profit, and over the course of the year, just under £800. So you can already see that choosing interest only versus a repayment mortgage is going to give you higher profits during the year. And that's one of the main reasons why we invest in property, to get an income, right? If you pay £25,000 deposit plus all of the stamp duty, legal fees, etc., you're going to be about £35,000 in. You're not going to put that much money into an investment to only get £800 in profit per year. That's a really, really bad return. That's the first point. So that's why we pay interest only instead of repayment, capital and interest. But I saw the second part of your question was to do with, hey, you don't own the asset in the end, which is true, but let me show you something else. In year one, you buy the property for £100,000, so that means you're going to put in a deposit and your mortgage is going to be £75,000. So your deposit is £25,000, usually 25%, and your mortgage is £75,000. Now, I'm assuming that the property grows at 6% per year because that's a rate at which, believe it or not, UK property has grown on average per year over the last 15 years, okay? So in year two, it grows by 6%, it's gone up to £106,000. Now, in the mortgage column here, in this cell right here, you can see £79,500. Now, what that means is that if you was to remortgage your property with the value having gone up slightly to £106,000, you're going to remortgage at 75%. So that now becomes £79,500, which is 75% of £106,000. Now stay with me, right? When you remortgage and you look to draw out equity from your property, you use that £79,500, that's a new mortgage on the property, you repay the original £75,000 and £4,500 goes into your pocket. You keep that tax-free. That's basically, in a nutshell, how remortgaging works. And that's how you draw out equity from your property. And obviously, over time, as the value of your property goes up, the more equity you can draw out. So if we go down to, say, 10 years' time, after 10 years of growing at 6% per year, the value of the property is £168,948. If you was to remortgage at 75%, you could now get a loan of £126,711. You pay off your original mortgage, £75,000, and you keep the rest, which is £51,711. Okay, that's equity in your pocket. You can do what you want with it. And over time, if you hold a property long enough, that's why I preach buy and hold. I don't sell properties. I intend to hold my properties for as long as possible. Your equity just goes up and up and up. So say after 15 years, you've still got the property and it's been growing consistently, you're able to draw out £94,568 worth of equity. What you might do at that stage, if you're a portfolio landlord, so you have multiple buy-to-let properties, you might take that 94,000 and pay off the mortgage of one of the other properties that you bought 15 years ago with a mortgage of around £75,000. So now you own that outright. Yes, you have a bigger mortgage on this property, but you now own outright other properties in your portfolio. And that's essentially how this works in terms of interest only and using equity, capital growth over time to increase your wealth, buy more properties, pay off other mortgages, really what you feel like doing. That's how it works. I hope that helps. Another question, nice. How many properties will you need approximately to be able to have £3,000 in income? Good question. So my original answer to this question was around about 6 properties. I currently own 3 buy-to-let properties, and my strategy, this is going to be key to answering this question. It really does depend on the strategy that you choose to employ with your buy-to-let properties. So me personally, right now, I have 3 regular buy-to-let standard AST, assured short hold tenancy agreement properties. So I have a tenant in there living anywhere between 6 to 12 months. The good thing about that strategy is it's straightforward, relatively low effort, relatively low risk, but you get a lower income. Now going forwards, I want to use more aggressive, higher risk but higher income strategies. And what you can see on screen highlights this. Now in column B, highlighted here, this is what I talked about first. These are the properties that I own. Standard buy-to-let short hold tenancy agreement properties. In one of my properties, I literally get £675 per month in rent. I pay mortgage interest of £280. I pay insurance, buildings insurance, and management fees to the letting agent. So after all of those costs each month, I am left with a profit of £304 per month net profit. Now, if I use that same property to do a different strategy, instead of doing standard buy-to-let, I used it for serviced accommodation, so booking.com, Airbnb, all that kind of stuff. As you can see, I can pretty much just under triple my income. And I'm assuming here that I'm filling it for 70% of the month, so 21 days out of 30 roughly, and getting around £90 per night. I've looked on what's available on Airbnb in terms of what the room rates are going. Pretty confident that I could get £90 per month on this property. I'd pay the same mortgage interest, same property, same buildings insurance. There'll be no management fees because I'll be managing it myself using the Airbnb platform. And then because it's an Airbnb property, you're responsible for all of the utilities. So electricity, gas, water, you're going to provide the internet, council tax. You might provide Netflix as well because guests like that. And cleaning and linens, that's a big one. So I've budgeted around about £300 per month for that. And that's the cost of a cleaner going in after each stay, cleaning it, changing the bed, washing, changing the linens, all of that kind of stuff, okay? But if I use that strategy, at the end of the month, I could go from a profit of £304 to round about £835 per month. So if I was to do that over my next 3 investments, say my next 3 property investments, I use this strategy, same types of properties, roughly the same nightly rates and same costs. Over my next 3 properties, I could get a monthly net profit of those combined of around about £2,400 per month. Add that to the 3 I have now, I'm getting around about £900 per month from the 3 that I have. That will nicely give me just over £3,000 per month in net profit from properties. So the key to this question and answering this question is it depends on the strategy you're using. The more aggressive, the more high risk the strategy, the more income that you'll get. But what I will say is note that I'm having a mix of those across my portfolios. I'm not just having a portfolio full of service accommodation properties. It's called diversification. I like to have a mixture of safe, regular buy-to-let properties, as well as higher risk serviced accommodation. You could also do HMOs and other stuff like that to spread the risk across my portfolio. I hope that helps. Next question or comment. Hi, great video. I'm looking to invest in Hull too, but it's far. I live in London too. Well, I don't know, I live in London, I invest in Hull, Sheffield and Manchester, so I'm literal living proof that it can be done. I mean, that's what you may think. Maybe you have to look at changing your perception of what's possible. The hardest part of investing in a different city is actually doing the research and buying the property in the first place. Once you've got the property, it pretty much does the work itself. As long as you've got a good letting agent, I don't have to look at my properties that often at all. The hard work is doing the research, going to viewings, traveling to a different city, figuring out what a good area to invest in is. If you want to know more about that, check out this video and I talk about how and why I invested in Hull and the process that I went through to choose in a different city. If you follow that advice and you follow that strategic formula each time, it's hard to go wrong. So it definitely is possible. Next question or comment, may all your tenants trash your properties?
Oh, you motherfuckers. Okay. All right.
Thank you for your comment. May you wake up in the middle of the night and step on an upright plug socket. Just kidding. I'm a good Christian. I wish you all the best. Keep commenting. It's engagement. It's good for my channel, even if it's negative. Next question. How does a limited company get a mortgage with no cash flow? You need to buy the property. You need the cash to buy the property outright. So no, you don't need to buy it cash outright if you're investing via a limited company. I invest via a limited company. What you need is a really good broker. I incorporated my limited property company less than 6 months before I made my first purchase. Some lenders might want to see a history of trading and income from the limited company, but not really. What they really want to see is your personal income and expenses. When you buy a property via a limited company, what the mortgage lenders are going to demand from you as the owner of that limited company is a personal guarantee, okay? So that way, from a legal perspective, if your limited company stops paying the mortgage because they are effectively the borrower, they can then go to you for the amount owed. That's how it works. That's really how banks and lenders protect themselves. So get a good broker. You do not need to have a trading history, okay, behind the limited company that's buying the property. Of course it does help, but you don't need to. It's not essential. They will look to you and your personal circumstances. They'll look at your affordability. They'll look at your income. Basically, they'll do all the same work as if you was buying the property yourself in your own name. The only difference is that they will ask you to provide a personal guarantee for the full amount of the mortgage, so that if the rent coming into the limited company doesn't quite pay off the mortgage, or if the limited company goes bust, whatever that can happen that stops the limited company from being able to repay the mortgage, they'll just come directly to you. So they'll ask you to get independent legal advice for that and all that good stuff. That's how it works. It's definitely possible. So get a good broker. Next question. Thanks for the information. Very insightful. You're welcome. What do you think of buying a property cash, then taking out the equity? Good question. Once again, I am going to show you what I think about that rather than tell you, because I'm a visual learner and I think it comes across a lot better and clearer using an example. So here is another spreadsheet. And again, don't get overwhelmed. I'm going to go through this line by line. So let's first of all look at what it looks like to buy the property via a mortgage, as most people do, as opposed to a cash purchase, and compare and contrast what that means for your equity and your return. So in this example above, the kind of brown burgundy color, let's say year one, you're buying a property for £100,000, and usually with a buy-to-let property, you have to put down 25%. So your deposit in column C is 25% and your mortgage is 75%, which is £75,000. That's what the bank lends you. So 25 plus 75, £100,000, you bought the property, all good. Now, year two, let's say your property grows by 6%. The average growth of properties in the UK over the past 15 years has been 6% per year, believe it or not. So that's what I'm assuming throughout. So year two, it's worth £106,000. Your deposit that you put in is still £25,000, and that carries on for as long as you own the property. That's always going to be how much you've put into the property. I'm assuming that. Now, if you was to remortgage in year two, and usually people remortgage to draw equity, because that was the second part of your question, out of the property, you could remortgage at £79,500. Why that number? Because it's 75% of £106,000. So when you remortgage, lenders tend to give you usually around about 75% of what the property is worth, i.e. the increased value, 75% of that. So what you will do with that £79,500 is repay your original mortgage of £75,000 and you keep the remainder, which is £4,500. Tax-free, in your pocket, do what you want with it. That's how it works. That's what I've done with my last 2 properties in the last 12 months, okay? I've drawn out just over £40,000 doing this. So in terms of a return, okay, you've put in £25,000 and you've been able to draw out £4,500. 18% return. Not bad, hey? And of course, as you go forward in time, as you hold the property for longer, the value goes up more and more and your equity increases. So let's fast forward to say year 15 and it's been growing at 6%. It's been carrying on growing at 6% per year. So now in year 15, it's worth £226,090. And say at this stage, you decide to take out some equity. So you can get the mortgage lender to give you 75% of that £226,090, which is £169,568. Out of that, you repay the £75,000 original mortgage. So you're left with £94,568,000 in your pocket. Tax-free, free money. All you've done is just hold onto the property and watch it grow over time. And then you can access the equity that's built up over time. That is a return of £378,000. Now, let's compare that, okay, to doing it with cash. So no mortgage involved. You just buy it cash. So day one, year one, you buy the property for £100,000. I've just put the deposit as £100,000 because, well, that is how much you're depositing into the deal. No mortgage. You own it outright, okay? No mortgage. £100,000 in. That's compared to £25,000 when you use the mortgage. So you're putting in more money, but you own it outright straight away. Now, let's fast forward to year 15. We just saw above, the numbers are all the same, essentially. It's grown 6% per year over 15 years, so it's worth £226,090. But your equity this time is £126,000. So you are getting more money out compared to £94,568. But look at the difference between the returns. One is 378% return, one is 126% return. Why the difference? The difference is because in this scenario where you used a mortgage, all you put in was £25,000 and you got back £94,568. So you put in less and your return is a greater multiple. In this second scenario where you've paid cash, you've put in 4 times more. So you've got more of your cash tied up in this property, 4 times more to be exact. So £100,000 versus £25,000. Yes, you're going to access 100% of the value increase, which is £126,090, but your return on what you put in is 126%. So in a nutshell, the reason why we use mortgages, leverage is what some people call it as well, is because you can maximize your returns. Now just imagine for a sec, right, that instead of putting £100,000 into this one property, you actually bought 4 properties, right? So if you're using a mortgage, all you need is £25,000. So you could actually buy 4 of these properties using that same amount that you've just put into one property below using a cash only purchase. Use a mortgage, you can actually buy 4. So then by year 15, for the same amount of money that you put into a cash purchase below in blue, just one house using £100,000, you could have bought 4 properties. Your equity after 15 years would actually be 4 times 94,000, 95,000. I can't do the math in my head, but it's roughly 390,000. I think it's just under £390,000. And we're talking over 1,000% return. That is why we use mortgages. You can use the same amount of capital, but get an even greater return by using the bank's money. I hope that helps. Okay, final question. Hello, looking to go into buy-to-let. Lots of conflicting information on buying in my personal name versus my company name. What would you advise? Let me go to an Instagram post that I did on this not so long ago. Follow me on Instagram, by the way. I'm at The Wealth Warren. Post a lot of helpful content, if I do say so myself. Now, should you buy property in a limited company? Now, let's look at these sides. So basically, it's all about what income tax band you lie in as a UK taxpayer. And by the way, get an accountant to advise you on this. But in a nutshell, it all depends on whether you're a higher rate taxpayer or a basic rate taxpayer. Look at your pay slip, your self-assessment return, and figure out what tax band you're in. I think most people know that already. But figure that out first. And on screen here, you can see what the current tax bands are in the UK. And then I talk about when to do it in your personal name. So as I said, if you're a basic rate taxpayer, generally you're better off buying in your personal name because you'll be taxed less and retain more of the rent that you received. Why is that? Because when you buy in your personal name, obviously your income from your work gets taxed at that tax rate, but so does your rental income. So the basic rate tax rate is 20% as far as I'm aware in the UK right now. So when it comes to your rental income, you're going to be taxed 20% of that, which, you know, is decent. If you're a higher rate taxpayer, you're going to be taxed 40% of your rental income. So the clear difference, right? You're going to be taxed 20% more, double, if you're a higher rate taxpayer. And that's when you want to start looking at potentially investing via a limited company. Why? Because rent is taxed at a lower rate when in a limited company. And also you're allowed to deduct certain costs from the gross rent before you get taxed, as we'll see on the next slide. So a worked example, let's assume that your annual gross rent is £10,000 and you pay mortgage annually altogether of £5,000. So on the far left, as a higher rate taxpayer at 40%, column A, that's your rent. You're going to get £10,000 per year in rental payments. Column B, that's after taking away your mortgage interest of £5,000. So you're left with £5,000. Column C, you're being taxed at 40%. Now that is 40% not of your net rent after taking away your mortgage interest. That's your gross rent. So it's very aggressive. So they're taking off £4,000. So you're left with £1,000 in rent. You can already start to see how taxation as a higher rate taxpayer on your rent is very aggressive. And they'll give you a tax credit of 20% of your net rent after deducting mortgage interest. So your income is £2,000, okay? If you're a higher rate taxpayer and you're getting a rent of £10,000 and a mortgage of £5,000. Compare that to a basic rate 20% taxpayer. Similar numbers in columns A and B. So you get £10,000 per year in rent, minus the £5,000 mortgage interest payments. So you've got £5,000 left in rent, and then you're then taxed at 20% of your gross rent. So that's 20% of £10,000, which is £2,000. So £5,000 net rent minus £2,000 tax, you're left with £3,000. They're going to add back that 20%, that £1,000 again. So you get £4,000 net income from your rent. So basically, using this example, a basic rate taxpayer is going to get double the amount of net rent at the end of each year than a higher rate taxpayer would, using this example. Okay, now let's say you're in a limited company. Okay, so you get that £10,000 again in annual rent, you take away the £5,000 mortgage interest, and the current limited company tax rate is 19%. So you're going to be left with roughly £4,000. Okay, at the end of the year, very similar to what you'd be left with if you was a basic rate taxpayer. But me, or maybe even you as a higher rate taxpayer, what would you rather have? Would you rather keep the property in your own name and be left with £2,000 net rent per year, or put it into a limited company and have £4,000? Real simple, okay, choice. And that's why, using this example, if you're a higher rate taxpayer, you're going to want to invest, generally speaking, in a limited company. But of course, get professional advice from an accountant. I'm not an accountant. This is not financial advice. Last question. Okay, this goes back to a video I made a while back about my failed Liverpool purchase. Hi, you said in the video you already had purchased off plan, which I did, yeah. Was this in Liverpool, and was the numbers they provided in terms of rental yield close or way off? Also, were their evaluation close to actual when they completed? And how did you secure a mortgage for that property if it was physically not there? I want to assist a friend who wants to buy it off plan. I personally have some doubts. Okay, in Liverpool right now, it's a hotspot, okay? It is a great city to invest in. But I personally, and I've heard other professionals say this now, not just me, generally avoid buying off plan in Liverpool because there are too many failing developments going on in Liverpool off plan. I was stung by that. I lost in the end round about £15,000 because it was never built in time. It never got signed off. Took him to court, spent a lot of money going through court and ended up losing round about £15,000. So I personally, if I was you, would not buy off plan in Liverpool right now. There's too much nonsense going on, okay, when it comes to these developers flooding into the city and building stuff that they don't finish. What I would do is just buy secondhand, buy a new build that's already been built, pre-owned, you know, 5, 10 years old. Do that. I wouldn't buy off plan if I was you. But to answer your question specifically, was this in Liverpool? Yes. Was the numbers they provided in terms of rental yield close or way off? They never finished it, so it was never rented out. I never got the property at the end of it, okay? So God only knows if the numbers were close or way off. I would say no. The fact that they didn't finish it, well, is a no, okay? Was there a valuation close to actually when they completed? No, they didn't finish it. I was stuck in that transaction for almost 2 years from memory. It was horrific, okay? Also, how did you secure a mortgage for that property if it was physically not there? Yeah, so the mortgage thing was a problem because a mortgage lasts, not enough will last for 6 months. So I had to keep renewing because the completion kept on getting delayed and delayed and delayed. And by the end, they had not gotten sign off, okay, from building control, from Liverpool Council. So you can't get a mortgage on a property that's not signed off by the council. Let's take this example off the table and say we're investing in an off-plan property that is going to be purchased, that is going to be completed on time and is going to actually be built. Yes, you can get a mortgage for that. They'll just keep renewing the mortgage. They'll go in, you know, closer to the date and see how far they are off of completion, and they will lend you. You can get a mortgage offer based on you know, off-plan development timelines and when they say they're going to build it and all the tracking that goes with that. So that's not a problem. You just need to focus on buying from a developer that's reliable. I would say at this stage, especially when it comes to hotspots or anywhere, to be fair, only go for developers that have a track record of completing developments, similar large developments, over years before. Don't go for no developer that's fresh into the game and saying, look, I'm going to build this 200 house development. We've never built anything before, but trust me, bro, we're going to finish it. And, you know, they're charging you like, you know, 5, 10, 20%. And they're asking for like, you know, 10, 20% deposit on the property. Don't do it. I personally would say do not do it. I hope that helps. Thanks for watching, guys, this Q&A. Thank you for all of your questions, guys. You did not disappoint. I had to do a lot of research and I had to do a lot of reading up for this, but I like it. I want to keep doing these. So keep putting your questions in the comment section. Put them on other videos and I'll keep making these videos because it's a great way to interact with you guys and give you real value. Like and subscribe, share this video, share this channel with other people because that's how this channel grows organically. And I'll see you on the next one.